Hello students, welcome to the lecture on long-term and short-term financing. And after this, we will be able to learn the following objectives. Explain financial market, define the concept of money market, understand long-term sources of finance, and explain the meaning and nature of short-term financing. Let us start with long-term and short-term sources of financing. Long-term sources of financial give rise to opportunity cash flows which, when discounted by a proper cost of capital, determine the market value of a company. Short-term sources of financial take account of overdrafts, short-term bank loans and trade credit. Functional capital management is a key factor in the company's long-term success. Without the oil of working capital, the engine of non-current possessions will not function. Financial market. A market is a place where two parties are involved in transaction of goods and services in exchange of money. The two parties involved are buyer and seller. Financial market is a platform where buyers and sellers are involved in sale and purchase of financial products like shares, mutual funds, bonds and so on. Capital market. A market where individuals invest for a longer duration, that is more than a year, is called as capital market. It is further divided into primary market. Primary market is a form of market where stocks and securities are issued for the first time by organizations. Secondary market. Secondary market is a form of capital market where stocks and securities which have been previously issued are bought and sold. Types of capital market. Stock markets. This market which deals with the issuance and trading of shares and stocks at a certain price. Bond markets. Bond market is a form of capital market where buyers and sellers are involved in the trading of bonds. Commodity market. A market which facilitates the sale and purchase of raw goods is called a commodity market. Money market. Money market involves individuals who deal with the lending and borrowing of money for a short time frame. Derivatives market. The market which deals with the trading of contracts which are derived from any other asset is called as derivative market. Future market. Future market is a type of financial market which deals with the trading of financial instruments at a specific rate wherein the delivery takes place in future. Insurance market. Insurance market deals with the trading of insurance products. Foreign exchange market. Foreign exchange market is a globally operated market dealing in the sale and purchase of foreign currencies. Private market. Private market is a form of market where transaction of financial products takes place between two parties directly. Mortgage market. A type of market where various financial organizations are involved in providing loans to individuals on various residential and commercial properties for a specific duration is called a mortgage market. Money market. The money market is that part of a financial market which deals in the borrowing and lending of short-term loans, generally for a period of less than or equal to 365 days. Definition of money market. Following definitions will help us to understand the concept of money market. The money market is a name given to the various firms and institutions that deal in the various grades of near money. The money market is the center for dealing mainly of short character in monetary assets. It meets the short-term requirements of borrowers and provides liquidity or cash to the lenders. It is a place where short-term surplus investable funds at the disposal of financial and other institutions and individuals are bid by borrowers, again comprising institutions and individuals, and also by the government. A money market is a mechanical device through which short-term funds are loaned and borrowed, through which a large part of the financial transactions of a particular country or world are degraded. A money market is distinct from but supplementary to the commercial banking system. Functions of money market. The major functions of money market are given below. To maintain monetary equilibrium, it means to keep a balance between the demand for and supply of money for short-term monetary transactions. To promote economic growth. Money market can do this by making funds available to various units in the economy such as agriculture, small-scale industries, etc. To provide help to trade and industry. Money market provides adequate finance to trade and industry. Similarly, it also provides facility of discounting bills of exchange for trade and industry. To help in implementing monetary policy, it provides a mechanism for an effective implementation of the monetary policy. To help in capital formation, money market makes available investment avenues for short-term period. It helps in generating savings and investments in the economy. Money market provides non-inflationary sources of finance to government. It is possible by issuing treasury bills in order to raise short loans. However, this does not lead to increase in the prices. Long-term sources of finance. Over a period of time, sources of finances have shifted from the traditional to increasingly non-traditional sources, largely due to the factors such as ease of obtaining capital, better rates of interest, lower regulatory and statutory obligations, better structuring and flexibility, as well as global perspective. Various sources of finance are equity capital. Equity shareholders are the owners of the business. The advantage of equity capital is that there is no fixed obligation for the payment of dividends. Preference capital. Preference shares have some attributes similar to equity shares and some similar to debentures. Debentures. A debenture is a marketable legal contract whereby the company promises to pay its owner a specified rate of interest for a defined period of time and to repay the principal at the specific date of maturity. Secured loans. These constitute one of the major sources of debt finance for a long-term project. They are generally repayable in more than 1 year but less than 10 years. Unsecured loans and public deposits. Unsecured loans and public deposits are often resorted to because they carry lower rate of interest, do not require any security or hypothecation, lesser formalities, and are comparatively for a longer period in comparison with working capital sources. Deferred credit. The deferred credit facility is offered by the supplier of machinery where the buyer can pay the purchase price in installments spread over a period of time. Internal accruals. Financing through internal accruals can be done through the depreciation charges and the retained earnings. Leasing and hire purchase. Leasing is a contractual agreement between the lessor and the lessee wherein companies can enter into a lease deal with the manufacturer of the equipment or through some other intermediary. In hire purchase, the ownership is transferred to the buyer after all the hire purchase installments are paid up. Government subsidies. The central and state government provides subsidies to industrial units in backward areas. Non-voting shares. These are useful for companies seeking to bolster net worth without losing management control. Detachable equity warrants. They are ideal for firms with growth prospects which prefer equity coupons to convertible debentures. Participating preference shares. These are quasi-equity instruments to bolster net worth without diluting or losing management control. Bought out deals. Buyout is a process whereby an investor or group of investors buy out a significant portion of the equity of an unlisted company with a view to take it public within an agreed time frame. Differences between debentures and share. Some of the various differences between debentures and share are: a person having the debentures is called debenture holder, whereas a person holding the shares is called shareholder. Debenture holder is a creditor of the company and cannot take part in the management of the company, while a shareholder is the owner of the company. It is a basic distinction between a debenture and a share. Debenture holders will get interest on debentures and will be paid in all circumstances. Whether there is profit or loss will not affect the payment of interest on debentures. Shareholder will get a portion of the profits called dividend, which is dependent on the profits of the company. It can be declared by the directors of the company out of profits only. Shares cannot be converted into debentures, whereas debentures can be converted into shares. Debentures will get priority is getting the money back as compared to shareholder in case of liquidation of a company. There is no restriction on issue of debentures at a discount, whereas shares at discount can be issued only after observing certain legal formalities. Convertible debentures, which can be converted into shares at the option of debenture holder, can be issued, whereas shares convertible into debentures cannot be issued. There can be mortgage debentures, that is, assets of the company can be mortgaged in favor of debenture holders, but there can be no mortgage shares. Assets of the company cannot be mortgaged in favor of shareholders. Sources of finance medium-term borrowing. Companies use several types of financing options in the course of their business operations. Medium-term financing may be used for special projects or business expansions that will result in new production facilities. Some of them are discussed below. Loans. The most popular financing for businesses are bank loans. Loans can be obtained for any amount and carry special terms for funding, length, and repayment. Leases. Leasing is an attractive financial option for companies needing equipment or facilities for a certain length of time. Lease generally range from 1 to 3 years, giving businesses options outside of traditional bank loans. Bonds. Large companies may issue business bonds to gain financing for medium-length projects. Equity. Small companies may provide medium-term financing through deposits of owner capital. Large companies may issue stock on a medium-term plan for generating new capital for business financing. Venture capital. Venture capital financing is generated by offering outside investors an ownership stake in the business for their invested capital. Meaning and nature of short-term financing. Short-term financing is that form of financing which embraces borrowing or lending of funds for a short period of time. It refers to the finance obtained on short-term basis, usually 1 year or less in duration. Short-term finance is secured for financing the current assets, for example, inventories. Practically all enterprises use the short-term credit as sources of finance. Sources of short-term financing. Following are the sources of short-term financing. Trade creditors. Trade creditors are those business establishments which sell good to others on credit. Customers' advances. Customers often finance the seller through advance payment for the goods. The prices of the goods to be purchased are paid in advance, that is, before the receipt of the goods. Commercial banks. The commercial banks of a country generally supply funds to the business concerns on a short-term basis, either with security or without security if the customer is financially established. Finance companies. Finance companies usually lend money to business. Commercial paper house. They are specialized financial agencies and they are created to purchase promissory notes and to sell them in turn to other investors who desire to have some sort of short-term liquid assets. Personal loan companies. These companies make small loans to individuals generally for consumption purposes. Factors or brokers. Factoring is based on a different philosophy. In considering a company's request for funds, we are more interested in the men behind the company, their ability, their hopes and aspirations for the future. Miscellaneous sources. There are many more sources from which secure funds for short period. They are friends and relatives, public deposits, loan from officer and the company directors, and foreign exchange banks. Advantages of short-term financing. There are many advantages of short-term financing. Easier to obtain. Short-term credit can be more easily obtained than long-term credit. Lower cost. Short-term credit may be obtained with lower cost than the long-term finance because of priority of creditors in general. Flexibility. Short-term financing is flexible in the sense that the firm is able to secure funds as they are needed and repay them as soon as the need vanishes. No sharing of control. Obtaining funds from short-term creditors prevents the inclusion of more owners through the procurement of owners' funds. Availability. In many cases, particularly for small enterprises, short-term credit is the only source available. Tax savings. The cost of short-term funds are deductible for income tax purposes, while the dividend paid to the owners is not deductible. Convenience. Short-term credit can be more conveniently secured than the other types of funds. Extension of credit. Many enterprises purchase equipment, supplies and goods by ordering from a supplier with the intent of paying after delivery has been made. Disadvantages of short-term financing. Some of the disadvantages of short-term financing are frequent maturity. Short-term credit is disadvantageous in the sense that it matures frequently. The principal must be repaid when due, otherwise the creditors may close the business. High cost. The rate of interest paid on short-term is usually higher than that on long-term credit. Purpose, goals of short-term financing. Following are the goals of short-term financing. Lowering of cost, raising funds according to necessity, facilitating prosecution of business with others' money, secure additional fund. Summary. Now in the end, let us summarize what we have learnt in this lecture. A market is a place where two parties are involved in transaction of goods and services in exchange of money. A market where individuals invest for a longer duration, that is more than a year, is called as capital market. Secondary market is a form of capital market where stocks and securities which have been previously issued are bought and sold. Short-term financing is that form of financing which embraces borrowing or lending of funds for a short period of time. A debenture is a marketable legal contract whereby the company promises to pay its owner a specified rate of interest for a defined period of time and to repay the principal at the specific date of maturity.